Last week was full of macroeconomic news, consumer sentiment, second quarter GDP, inflation, and the labor market. And all of this data was supposed to answer the question that is on the market's minds the most: when will the Fed finally stop tightening the screws? In fact, this week's market dynamics should be viewed through the prism of this question. Hi, this is a quick review from Ivan Kompan, Edinburgh Business School analyst.
What's bad for the economy is good for the markets. This week this rule was in full effect. The estimate of GDP in the second quarter was lowered to 2.1%, while it was expected to be 2.4%, but markets rose. The number of job vacancies in the country decreased, but markets rose again. The number of jobs created in the private sector was less than expected, and this time the markets rose. It was only when it turned out on Thursday that inflation was exactly as expected, slightly higher than the previous month, that the markets partially turned red, probably to take a break before the main event of the week, the labor market report.
The worse the state of the US economy, the more likely it is that the Fed will pause, or even start cutting interest rates altogether. But will this bring joy to the markets in the long run? As a result, over the week, the likelihood that the Fed will pause in September has increased, while the likelihood that it will raise rates again by the end of the year has decreased. Hopes for a reversal have strengthened significantly over the past week.
The August labor market report was expected to show some cooling, but the results did not provide a clear picture of what is happening. The number of jobs created rose to 187,000, while 170,000 were expected, but the unemployment rate increased from 3.5% to 3.8%. The cost of labor also continued to rise by 0.2%, which is less than the expected 0.3% and 0.4% in July. Overall, it is probably too early to draw a final conclusion about the Fed's success in cooling the labor market, but at least it is no longer boiling over, which was positively assessed by the market.
What's next? It all depends on the Fed. It seems that most investors hope that inflation will continue to decline, consumers will continue to buy, and the economy will continue to grow, albeit more slowly. Far fewer believe that a rapid rate hike will still have a powerful negative effect and that the landing may be tougher than most believe. With the S&P 500 yield at 4.7%, only slightly above the yield on 10-year US government bonds and below the yield on short-term bonds maturing in 2 years or less, it would be too optimistic to expect a rapid rise in the stock market.
And finally, we would like to remind you that the information you have just listened to is not an investment advisory. Remember, investments in the stock market are always tied up with financial risks. So be careful and cautious. Like and subscribe to our YouTube channel. See you soon!